In this video, I'm going to go through the solution to the question Lavenir Limited. I modified the question and sent you all a link, but I'll include the document link in the introduction to the video description on YouTube. So we have the question here. You've got the projected balance sheet of Lavenir Limited at the 31st December 2019. And again, a pretty typical balance sheet. You've got your fixed assets, some intangibles, current assets, liabilities, short-term and long-term, and total net assets of 999,000. And of course there is a series of notes which inevitably are going to contain relevant information for the solution. So I'm going to demonstrate the solution side by side, if I can make this work. Okay, so the starting point is of course filling in the accounting book values, and as I demonstrated in the last question, it's possible to fill in all the values other than maybe the tangible fixed assets, because often there is a calculation needed for any permanent difference issues. So I'll just slot in the accounting book values for the other assets and liabilities. So these could be just slotted in directly. So there's no issues there. Trade payables all the way down to bank loans. Okay, and then the provisions for liabilities and finance leases. Okay, 30, 25 and 30,000. Okay, so now I'm going to start looking at the tangible fixed assets. Is there an issue to contend with in relation to permanent differences? So looking at the Word document on the left of the screen, tax and net book values are given in note 1, so you've got accounting book values as indicated there, and tax written down values as indicated here. Now, I suppose the key statement, and the one that makes life a little bit easy for us, is the motor vehicles are all commercial trucks and vans. So just even that single word, commercial, tells me that there's no restrictions placed on the qualifying cost for tax purposes. The tax base isn't restricted for commercial vehicles. The restrictions only apply to passenger cars. So that's actually allowing us then to slot in the full value for the tangible fixed assets. There's no permanent difference to contend with. Tax written down values, 500 plus 240 plus 55. So that's going to be 795 for the tax base value. Okay, these assets attract capital allowances, so the tax base is 795. Okay, now moving to item 2, okay, I'm going to see, can I split the screen here to maybe leave the stuff visible? Okay, so to item 2, intangible assets, and you can see I modified the original question for these. I just wanted to incorporate something that we hadn't seen in previous questions. So intangible assets consist of the fund. You've got development costs 20,000 and trademarks 30,000. You have a total of 50,000, and the trademarks qualify for capital allowances. Okay, well that's again a key statement that tells us all we need, which are being claimed by matching the annual capital allowances claim to the amortization of the trademarks. Now, okay, that statement is slightly mysterious perhaps. You may recall, or you should recall, that for these intangible assets, such as trademarks, brand names and similar, you've got two options when it comes to claiming capital allowances. One is you can claim a straight line rate of 7% for 14 years and then 2% in the 15th year, so 7% of cost each of 14 years. Or alternatively, you can match the amortization of the relevant intangible asset, the amount you depreciate in your income statement, with the tax claim for capital allowances. And that's what's happening here. If you choose that option, what that implicitly tells you is that the tax base and the accounting book value must match. Because if you amortize an asset by, say, 10,000 euros, you claim a wear and tear allowance for 10,000 euros also. So the statement that the capital allowances are being claimed by matching the annual capital allowance claim to the amortization of the trademarks tells me that the particular assets would have a tax base value of 30,000. In relation to the development costs, okay, you should have seen this from other questions. The accounting book value is 20,000, but they're allowed using a cash basis. Okay, remember you get the deduction for a development expenditure in the period in which it is paid. So again, if you just think of the words there, that you get the tax deduction when the expense is paid, it's the same as saying that you're allowed the deduction on a cash basis. And if it's a cash basis, the tax base is always zero. For these ones, the tax base is basically capital allowance basis. So tax written down value will match the accounting book value. So accounting book value 50, tax base value 30. So that's 30,000 there. Inventory, okay, there's never an issue here. Trade receivables, didn't have anything in the question about bad debt provisions. You saw in the previous question for Listless Limited that if there's a general bad debt provision, which in reality is becoming increasingly rare, general bad debt provisions are going out the way of the arc at this stage. So they are not something that are likely to feature in future accounting statements and indeed in future tax questions. So there isn't an issue with them in this question, but if, say, that had been reduced by 1,000, so the gross debtors were 87,000, and there was a general bad debt provision of 1,000 to give you 86, you'd have 86 here and 87 for the tax base, because general bad debts are only allowed to be deducted when actually incurred, essentially when they get converted to specific bad debts. Doesn't arise in this question, so not an issue for us to contend with. Prepaid expenses, there's nearly always something to at least check here. So 7,200 consists of the following amounts. You've got light and heat, pension premium, rental income and rental lease premium, and you're told in relation to the rental income. So in December 19, the company signed a rental agreement to sublet part of a Dublin property it owned to an Irish-based client under the following terms. So there's a 4-year term, rent due of 1,000 per month payable at the end of the month, premium payable, 5,000 payable on 31st December 2019. And these have all been recognised in the financial statements. Okay, so rental income, so again, just slot in the tax-based values. Light and heat, okay, you should recall, and from your case 1 computations, that if light and heat is accrued, it's perfectly fine for case 1 computation. There's no add back, so it's allowed on an accruals basis. So if it's allowed on an accruals basis, the tax base matches. Okay, that's the rule, that if this word here is accruals, these two values match. Pension premium only allowed when paid, so cash basis, which again tells me straight away that that has to be a 0. The rental income and the premium all charged on an accruals basis. So the again, both amounts are going to have a matching tax base. So there's actually just one item of difference there. Okay, and the accounting book value is 400 greater than the tax base value, so 6,800. Cash at bank, never an issue. Trade payables likewise. Accrued expenses. Okay, so accrued expenses consist of wages due, telephone and staff Christmas party contribution. Sometimes the issue here is, again, you could have accrued pensions, you could have accrued penalties, and in both of those instances there is care needed to be taken. Accrued pensions allowed on a cash basis, so the tax base would be 0. Penalties are permanent differences, so the tax base value must match the accounting book value. And these ones here, there's no real issue. Okay, so the wages, the telephone and staff Christmas party, 1,400, 1,700 and 1,000, and they're all allowed on an accruals basis, so the tax base matches the accounting book value. Okay, so 4,100 on both columns. Taxation due, no issues. Short-term loans, no issues. Again, it's probably worth noting that if that was a finance lease, there would be an issue. Okay, this is a bank loan. not a short-term portion of a finance lease. Finance leases are only allowed on a cash basis. So if that said short-term portion of a finance lease, this value here would be 0. But that's not the case, obviously, in this question. There's a note there about taxation due, and that affects the ledger account portion of the solution, which I will look at later. Now, I've highlighted here a number of years ago the company had undergone a significant corporate restructuring, which was necessitated due to ongoing losses. The restructuring has proven successful, and the company is now making profits and anticipates doing so in the foreseeable future. And in bold, accordingly, the company wishes to recognise the tax saving value of $16,000 in trading losses, which it had previously not recognised. So just to kind of set the background here, the issue is with recognition of the tax saving of losses. So if you're in a loss-making situation, the prudence concept tends to dictate that you shouldn't recognise that the loss you have made will save you tax down the road, because there may not be a down the road period. You may be insolvent, you may have to close up shop. So we don't want to recognise an asset until we are pretty confident then that it can be utilised. So that 16,000 in trading losses will save them money down the road, and they now reckon that they can actually recognise it's a deferred tax asset. Now, it doesn't go into the balance sheet comparatives. Okay, we don't have an accounting book value here for tax loss amounts in the accounting book value. So what I do is I'll do an adjustment underneath after I've done these main components here. So we're going to see that this is the first such question where this has occurred, and it's a concept that occurs in a couple of questions. The other point probably worth making is that you are permitted in Ireland to offset the losses against the equivalent income, and the accounting standard does state that if that happens when calculating your deferred tax, you're allowed to deduct assets from liabilities. Okay, and that's what we are going to be doing in this question. In some jurisdictions that may not apply, and in which case you'd have to separately show at the end of the question a deferred tax asset and then a deferred tax liability in separate sections of your balance sheet. But in this instance in Ireland, because the losses are deductible against the equivalent income, that won't be an issue for us. Okay, so provisions for liabilities consist of the following amounts: provision for repairs 24,000, provision for deferred tax 1,000, and this provision was made in full this accounting period, and it complies with the criteria as set out in IAS 37. IAS 37 replaced FRS 12, and in essence, when you see a statement of that type, it means that the tax base value will match the accounting book value. I just took off the revenue.ie website the specific PDF document in which this issue was outlined, and I've highlighted in it the key points. So a provision or accrual recognised in accordance with IFRS's or Irish GAAP, so IAS 37 is the one I've been looking at, is acceptable for tax purposes subject to normal tax rules. So once the nature of the item itself is a deductible item, it's not like a provision for new purchase of machinery or something like that. So if it's a provision for repair, repairs are allowable, and therefore you can deduct it on an accruals basis. Okay, so the provisions will match. Okay, the provisions will match the accounting book value. Finance leases, okay, worth highlighting that actually. Okay, finance leases, as you may recall, in case once you add back the interest and you get to deduct the amount paid, but it tells you that they're allowed on a cash basis. Okay, so finance leases are allowed on a cash basis. So that gives us total of 999 versus 883 600, and the total difference then are 115 400. And here's the new little bit I want to highlight. We are going to deduct the losses now recognised. So we have trading losses that we can now benefit from, 16,000, that's a deferred tax asset, and that gives us a adjusted difference of 99,400. Their value of 12.5% is 12,425, and that, as you saw in previous solutions, is the desired closing balance on the deferred tax provision account. So in the next part of the video, I'm going to look at the ledgers. Okay, so for the ledgers, we're asked to prepare the corporation tax liability account, the corporation tax expense account, deferred tax provision account, and the note disclosure. So just to go back to the question to look at the key values we need. Okay, so I've got note 5 on display here. So the taxation value consists of the following amounts. There's VAT and there's corporation tax. Okay, that's obviously the one that we're going to be using in our corporation tax account, corporation tax liability account. So it represents a prior year over provision. Okay, and again, I've talked about this in a previous video about under and over provisions. So just to again briefly recap, we estimated perhaps last year that we owed, say, 20,000 euros in tax. So we created a liability for 20,000, credit tax liability, debit tax expense. And then when we went to pay it, we only found out that we need to pay 18,000. So credit bank and debit tax liability. So the 2,000 euros is sitting over. It doesn't represent an actual liability of the company. It can be eliminated. So that's one of the tasks we're going to be doing. Current use provision is estimated at 30,000. So we're going to create a liability for 30,000. And there's a dirt credit of 200 available in respect of the accounting period. So the liability will be actually reduced by 200 euros, and that means debit liability, and as you hopefully recall, you'll be crediting, in this case, interest income account. I've talked about the losses in the context of deferred tax. The other thing that is relevant for the ledgers is the provision for deferred tax of 1,000. This is the opening balance in the deferred tax account at the start of the year. So that's going to obviously go into my deferred tax account. So switching to the ledgers, I can start by putting in the existing opening balance on the liability account. This is the over provision we're going to get rid of in a moment, and the deferred tax opening balance 1,000. Now we're asked to create a liability of 30,000 this year, and we also have to get rid of this prior year over provision. So debit the tax liability account and credit the tax expense account. Okay, so that just tidies up the tax liability account. At this point, there's nothing owed to anybody in relation to tax liabilities. Now we'll create the new liability. So we estimate it as 30,000 this year. So credit the liability account and debit the tax expense account. 30,000 each account. And we have a tax credit available which reduces my liability. So debit the liability account 200 and credit the interest income account. So the interest income would be shown gross. Okay, now that can allow me then to get the closing balance. So essentially I'm going to owe the 29,800 to the tax office. That's the 30,000 less the 200 credit. Okay, so that closes that. So that's my closing balance, 29,800. The tax expense account, I need to deal with the movement on the deferred tax provision. So we saw that the desired closing balance was 12,425 on the deferred tax provision account. So we can slot that into the deferred tax provision, desired closing balance 12,425. So there's a net movement of the difference, okay, 11,425, and that's going to be credit deferred tax and debit the corporation tax expense account. So the corporation tax expense account then needs to be just balanced off. So we've got 41,425, which means that the figure that will appear in my income statement for tax on profits for the year, 39,425, being the difference between the two sides. Okay, so excuse me. The final bit then is the disclosure of the P&L tax charge, which in essence is just taking the corporation tax expense account and tabulating the elements within it. So we've got 30,000 less a prior year over estimate of 2. We've got 11,425, which is actually consisting of a deferred tax asset and deferred tax liabilities. So we'll see how that is displayed. So we start off with our 30,000. Okay, so estimated tax charge is 30,000 for the year on profits, and we can deduct from that the prior year. Okay, so that's 30,000 gone. Deduct the tax liability, the prior over provision of 2, so that leaves us with 28. Okay, so 28. And then we have, okay, and this is worth noting here, the benefit arising from prior tax losses now recognised. That's the 16,000 euros at 12.5%. Okay, so we separately show these newly recognised values for tax losses in our note. Okay, so 16,000 is the value of the trading loss, and the tax saving of 12.5% represents 2,000 euros. So 2,000 euros there. And then that means that the 11,425 must have been a liability of 13,425 less 2,000. So that goes in as a single line item, and the result then is given as taxation charge 39,425.